Everyone says the same thing about covered calls. They limit your upside. You cap your gains, you miss the big moves, and in a bull market, you would have been better off just holding the stock. That's what the textbooks say. That's what every options course teaches. I tested 600 configurations across 5 stocks over 8 years. Covered calls didn't just match buy and hold. They beat it. On every single stock, TSLA covered calls made $810,000. Buy and hold made $16,000. That's not even close. Here's the setup. I backtested covered calls on SPY, QQQ, AAPL, NVDA, and TSLA from 2016 to 2024. That's 8 years of real options data through a massive bull market, COVID crash, 2022 bear market, and the 2023 AI rally. For each stock, I tested 120 configurations, 3 delta levels at 0.2, 0.3, and 0.4, 4 DTE windows at 7, 14, 30, and 45 days, and 2 exit methods, hold to expiration or roll at 50% profit. That's 600 total configurations. The strategy is simple. Buy 100 shares, sell a covered call, and when it expires or hits your exit target, sell another one. Repeat for 8 years. Then compare the total return, stock gains plus all premium collected, against just buying and holding the stock. Let's start with the headline. Every single stock, the best covered call configuration, beat buy and hold. Look at these numbers. TSLA. Covered calls made $810,691. Buy and hold made $16,836. That's a $793,000 difference. NVDA. Covered calls made $375,137 versus buy and hold at $6,031. A $369,000 gap. Even SPY, which is the boring index ETF, covered calls made $118,153 versus $27,872 for buy and hold. That's a $90,000 difference on a single stock position. And look at the best config for each stock. Every single one used 30 DTE. Every single one used hold to expiration. The only thing that changed was delta. The volatile stocks like TSLA and NVDA performed best at 0.4 delta, collecting more premium. The ETFs like SPY and QQQ performed best at 0.2 delta, avoiding assignment. This is important because it tells you the strategy isn't random. There's a clear pattern. Let's break down the DTE comparison. I combined the best covered call P and L across all 5 stocks at each DTE window. 7 DTE, $626,000 total. 14 DTE, $981,000. 30 DTE, $1.6 million. 45 DTE, $1.16 million. 30 DTE crushed everything else. It made 2.5 times more than 7 DTE and 37% more than 45 DTE. Why? 30 DTE hits the sweet spot of theta decay. You're selling in the zone where time decay accelerates the fastest, but you still have enough premium to make it worth the trade. 7 DTE gives you tiny premiums. 45 DTE gives you bigger premiums, but ties up your capital longer and exposes you to more directional risk. Now, let's talk about delta. This is where it gets nuanced. At 30 DTE, hold to expiration. Look at the split. For SPY and QQQ, 0.2 delta was the clear winner. SPY at 0.2 delta made $118,000. At 0.4 delta, it dropped to $84,000. QQQ showed the same pattern. But for TSLA and NVDA, It's the exact opposite. TSLA at 0.4 delta made $810,000. At 0.2 delta, it made $346,000. Still great, but less than half. The reason is volatility. High volatility stocks generate massive premiums at higher deltas, and even though you get assigned more often, the premium more than compensates. Low volatility stocks like SPY don't generate enough premium at high deltas to offset the assignment cost, so the optimal delta depends on the underlying. Now, the exit method. Hold to expiration versus rolling at 50% profit. This one surprised me. I expected rolling to win because you lock in profits and reduce risk. But hold to expiration won on every single stock, and it wasn't close. On TSLA, holding made $810,000 versus $625,000 for rolling. That's $185,000 left on the table by rolling early. On SPY, holding made $118,000 versus $34,000 for rolling. That's a 3.5 times difference. Why? When you roll at 50% profit, you're often buying back the call at a loss relative to the premium you could have collected by just letting it expire. You're also triggering more trades, which means more bid-ask spread costs. And in a trending market, holding to expiration lets you capture the full premium on the winning trades. Let's do a deep dive on TSLA, because these numbers are insane. The best config, 0.4 delta, 30 DTE, hold to expiration. 416 trades over 8 years, 86.1% win rate. Total P&L, $810,691. This is on a single stock position. And here's the kicker. Buy and hold on TSLA over the same period only made $16,836. So covered calls made 48 times more than buy and hold. How is that possible? TSLA has extreme volatility, which means massive option premiums. At 0.4 delta with 30 DTE, the average premium collected was $1,873 per trade. Over 416 trades, that's $820,364 in total premium. The stock itself barely moved in price from start to finish. It went from $223 to $248. But the premiums collected along the way absolutely dwarfed the stock appreciation. This is the power of covered calls on volatile stocks. So here's the verdict after testing 600 configurations across 5 stocks over 8 years. Covered calls beat buy and hold on every stock tested. The myth that covered calls limit your gains? It's wrong. At least over this time period, the premium collected more than offset any capped upside. The optimal setup, 30 DTE, hold to expiration. For delta, use 0.2 on low volatility ETFs like SPY and QQQ, and 0.4 on high volatility stocks like TSLA and NVDA. Rolling at 50% profit consistently underperformed holding to expiration. And the biggest finding, on volatile stocks, covered calls don't just add income. They completely transform the return profile. TSLA went from $16,000 to $810,000. That's not a minor improvement. That's a different strategy entirely. 600 configurations, 5 stocks, 8 years, and covered calls won on every single one. If you found this useful, hit subscribe. I'm backtesting every option strategy with real data so you don't have to guess. Drop a comment and let me know. Are you running covered calls? What delta and DTE are you using? I'll see you in the next one.